Welcome back to the deep dive. You know, if you've been looking at the headlines in January 2026 and thinking, wait, did I just wake up in some kind of alternate timeline? You are definitely not alone.
Not at all. It's been a wild start to the year.
I mean, we are looking at a world where the United States is weaponizing tariffs to try and literally buy Greenland.
Right.
We're seeing energy grids failing right when we need them most, sending Europe into a total panic. And maybe the most surprising thing, the crypto market is going through this total legislative overhaul that actually seems to make sense.
It's a chaotic start, to say the least. We've been calling it the global rupture. It really feels like the old playbook, the one we've all been using for the last decade of investing, has just been thrown out the window.
Completely.
The correlations are broken, the alliances are shifting, and money is moving in ways that, frankly, defy the textbooks.
Exactly. And to help us navigate this rupture, we are diving deep into the ASWA9 Market Pulse, issue number 6, from February 2026. This isn't just a newsletter. This month, it really reads like a survival guide for a world that's gone a little bit off the rails.
It really is. We have a lot of ground to cover today. The main goal is to decode the signal from the noise because, let's be honest, the noise levels are at an all-time high.
Yeah.
We have sovereign nations acting like distressed assets, and we have digital assets starting to act like sovereign nations. It's an inversion of everything we thought we knew.
Before we get into the madness of the markets, and I promise we are going to unpack that Greenland story because I still can't quite get my head around it.
Right.
We have some pretty massive news from the publishers of the source material themselves.
Right.
This is a mandatory update because it kind of changes the whole structure of who is bringing us all this data.
It's a big milestone, and I think it really speaks to the maturity of the analysis we're using here. The parent organization behind the magazine and the community has officially incorporated in the United Kingdom.
Oh, wow. Okay.
They are now A&K Quant Holdings Ltd.
Holdings Ltd. That sounds very, very official. It's not just a blog anymore.
It's very official. And this move, it establishes AnyTrader and ASWA9 and the ASWA9 4U brand as official trademarks of the company.
Yeah.
So, ASWA9 is no longer just a community project or a side hustle.
Right.
It is an official publisher office legally operating in the UK.
That is a huge step up in professionalism. It gives a lot more weight to the data we're about to dig into. And for everyone listening who is part of that community or maybe just wants to reach out to the editors, there's a logistical change you need to know about, right?
Yes, this is important. So write this down or, update your contacts right now. The official email address has switched. It is no longer a Gmail address.
Right.
It is now contact@aswan9mag.com. So if you're sending in questions or feedback, just make sure it goes to that new domain.
All right. Housekeeping done. Let's get into the meat of this global rupture. When I opened the magazine and looked at the scoreboard for January 2026, the first thing that jumped out at me was the currency market. It looks violent.
Violent is the good word for it. We're seeing what feels like a critical inflection point for the U.S. dollar. The dollar index hit its lowest level since June. Now, usually when the U.S. is flexing its muscles geopolitically, which we will get to, the dollar strengthens.
Or the safe haven flight.
Exactly. But here, the narrative that's taking hold is that the Federal Reserve is behind the curve.
Behind the curve in what way? Like they're not cutting rates.
The market thinks they aren't easing fast enough compared to other central banks. Or, maybe more accurately, that the U.S. economy is showing these cracks that the Fed just isn't acknowledging yet. So the dollar is paying the price for that.
The confidence game.
It's always a confidence game. And right now, confidence is wobbling.
So let's look at the winners and losers in Forex because there's a story right there in the divergence. Who came out on top?
The top gainer was USDMXN. It's up 5.06%.
So the dollar went up against the peso. That means the peso weakened pretty significantly.
Exactly. And you have to look at why. Mexico is so heavily dependent on U.S. trade stability. When the U.S. starts throwing tariffs around and, threatening its neighbors, the peso gets very, very nervous. It's a classic risk-off move for Mexican assets.
And on the flip side of that, who is the biggest loser against the dollar?
That would be the USD-BRL pair, down almost 6%.
Wow.
Which means the Brazilian real strengthened massively against the dollar.
Okay, that's a huge divergence. You've got the two giants of Latin America, Mexico, and Brazil, and one's currency is crashing while the other's is flying. What's driving that split?
It's the commodity supercycle versus trade war risk. Mexico is, at its heart, a manufacturing partner to the U.S., so they suffer directly from trade instability.
Right.
But Brazil sells food, oil, and raw materials to the entire world, When global instability hits, people buy hard commodities, and that money flows straight into Brazil. It's a flight to resource safety.
That makes perfect sense. But the one I really want you to walk me through is the euro. The EUR-USD pair, I saw in the report it's pushing up against that 1.2 thousand level.
Ah, yes. The big one. See, 1.2 thousand isn't just a number on a chart. It's a huge psychological barrier.
Yeah.
Historically, that 1.2 thousand level is the line in the sand between negative rate regimes and normal monetary policy for Europe.
Break that down for me. Why does crossing that specific number matter so much?
If the euro breaks 1.2 thousand and holds it convincingly, it signals a massive shift in capital flow away from the U.S. and into Europe. It tells us that the big global allocators, pension funds, sovereign wealth funds, they believe that even with the energy crisis in Europe, the Eurozone is fundamentally undervalued compared to the U.S.
So it's a bet on European resilience and a bet against U.S. dominance.
That's it in a nutshell.
Which feels so counterintuitive given the energy crisis over there, which I know we'll get to later. I mean, Europe is literally freezing, yet their currency is strengthening. That feels like a trap.
It might be. Or it could be that the market has already priced in the freeze, and now they're looking at the political situation in the U.S. and saying, you know what, I'd rather take my chances with the cold weather than with that political volatility.
Fair point. Okay, let's switch gears to crypto. January was a weird month, wasn't it? I feel like I saw all these headlines about regulations being a good thing, but then I look at my portfolio and Bitcoin was down about 10%.
It was. Bitcoin consolidated. It dropped about 10.58% to be exact. But, and this is a really crucial point, the experts in the magazine argue this isn't a crash, it's a repositioning.
I feel like repositioning is what financial advisors say when they lose your money. What is the difference, really?
A crash is pure panic. A crash is when volume spikes because everyone is rushing for the exit door at the exact same time. Repositioning is when big money is just moving chips around the board.
Okay.
Volume was steady, not frantic. And while Bitcoin took a breather, look at the ecosystem coins. USD was up over 15%. TonySD, that's the Telegram Open Network, was up over 11%.
So the big dog is sleeping, but the puppies are running around the yard.
Precisely. If it were a real crash, everything would be deep in the red. But what we're seeing is rotation. And the meme coins are dying. DOGE was down almost 15%. The meme fade is real.
So the dog money is finally going to the farm.
It certainly looks that way. Investors are moving away from jokes and into actual infrastructure. I mean, SUI and Tion are building real platforms. DOGE is, well, it's a vibe.
Right.
And in a global rupture, vibes don't pay the bills. But here's the nugget that really caught my eye in this section, the alt season index.
I saw that chart. It's sitting at 29. That sounds really low.
A 29 on the alt season index is very low, which just means Bitcoin has been dominant. But from a technical perspective, it's forming a falling wedge pattern.
Okay, visualize that for someone who's driving right now. What does a falling wedge look like, and why is that supposed to be a bullish sign?
Okay, so imagine a price chart where the highs are getting lower and the lows are also getting lower, but the whole range is getting tighter and tighter. It looks like a cone or a wedge pointing down.
Got it.
It represents selling pressure that is just running out of steam. Historically, when the index hits this level and forms this specific pattern, it acts like a coiled spring. It often precedes a massive explosion in altcoin value. We could be talking about a proper alt season, where the smaller coins significantly outperform Bitcoin.
So if you're holding bags of alts and you're feeling the pain from January, the data here suggests patience might actually pay off. Don't sell at the bottom of the wedge.
Exactly. The math suggests we are much closer to the turn than we are to the cliff.
Let's move over to stocks. I saw a really interesting divergence here. Usually, when the U.S. tech giants sneeze, the rest of the world catches a cold. If Apple is down, the German DAX is usually down too, but that didn't happen this time.
No, it didn't. And this is part of that whole decoupling theme we're seeing. U.S. mega-cap tech, your NVIDIAs, your Apples, they're consolidating. They are flat or down. But Europe and Asia, they're surging. The German DAX broke 25,000 for the first time ever.
That is wild. Why the rotation? Is U.S. tech dead?
Not dead, just expensive. Investors are looking at U.S. tech valuations and saying, okay, this is priced for absolute perfection. Then they look over at Europe or some emerging markets and say, this stuff is priced for disaster, but the disaster maybe isn't that bad. It's a classic value play. We saw the KOS ticker up 77% on energy price surges. We saw BRK up 54%.
But not everyone was a winner. You mentioned trade wars earlier. What happens when a stock gets caught in that crossfire?
It gets annihilated. Just look at some of the Chinese auto parts stocks. The ticker MTEN was down 98.8%.
Oh, stop right there. 98.8%. That's basically zero.
That's what a trade war looks like on a balance sheet. It's a total wipeout. If you had $10,000 in that stock, you now have roughly $120. That is the risk we're talking about in 2026. It's not just market risk anymore, it's existential policy risk.
Okay, let's unpack the biggest theme of this issue. The cover story is Crypto Regulatory Clarity, the Institutional Reckoning. For years, the narrative has been regulators hate crypto. The SEC is coming for you. But in 2026, it seems like that narrative has completely flipped.
It absolutely flipped. We have moved from crypto as a casino to crypto as infrastructure. And this isn't just a vibe shift, it's actual legislation. The U.S. government finally realized they can't kill it, so they've decided to co-opt it instead.
Talk to me about the Genius Act.
Best acronym ever.
They clearly started with the word genius and then worked backward to make a name.
They absolutely did. I don't even know what it stands for, but here's what it does. It was signed back in July 2025, but it just became operational in January 2026.
Yeah.
This act essentially builds the legal scaffolding for institutional crypto adoption. It provides safe harbor. It tells the big banks, if you touch this stuff, you won't go to jail.
And that's the green light they have been waiting for years.
Yes. And then you have the Clarity Act, which is advancing through the Senate. The combined impact of these two pieces of legislation is that the regulatory risk, that fear that the SEC is going to sue you into oblivion, is pretty much gone.
Wow.
The source mentions that 74% of family offices are now actively exploring digital asset exposure.
That is a staggering number. 3/4 of the big private money is looking to get in. But why now? Is it just because it's legal?
It's because the rules are finally clear. Big money hates uncertainty. They don't mind risk, but they absolutely hate regulatory uncertainty. And this whole transformation rests on what the magazine calls the 3 pillars.
Okay, let's break those down. Pillar 1 is infrastructure. What does that actually mean in practice?
So this is the OCC, the Office of the Comptroller, the currency approving national trust bank charters for stablecoin issuance.
Okay, that sounds really boring.
It sounds boring, but think about it. It means your regular bank, the one with the ATM on the corner, can now legally issue its own crypto dollars. It integrates stablecoins directly into the core banking system. It completely blurs the line between money and crypto.
Okay, wow. Pillar 2 is jurisdiction. This has been the turf war of the century. Who is the cop on the beat, SEC or CFTC?
This was the biggest fight, yeah. And the harmonization is finally happening. The new rule is basically this. Most tokens are digital commodities. That means they fall under the CFTC's jurisdiction. They are not securities.
That is huge. So something like Ethereum is not a security.
Exactly. It's treated like wheat or corn or oil. It's a commodity. Only tokenized securities, things that actually represent ownership of a stock or a bond, stay with the SEC. Everything else goes to the commodities regulator. This just clears up the entire mess that held everyone back. The SEC can't sue a commodity.
And Pillar 3, this one sounded like it's still a battleground. Stablecoin yield.
This is the big fight over Section 404.
Sounds like a page not found error.
It might as well be a profit not found error if the banks get their way. Here's the conflict. The big banks want to ban all interest payments on stablecoins.
Why would they want to do that?
Because they're terrified. I mean, if you can hold a digital dollar, a stablecoin, and get a 5% yield from the protocol, why would you ever keep your money in a traditional checking account that's paying you 0.01%?
You wouldn't. I certainly wouldn't.
Of course not. The banks see stablecoins as an existential threat to their entire deposit base. So they are lobbying like crazy to protect their deposits by making stablecoins yield-free by law. But the crypto industry is fighting back for yield preservation.
So it's the incumbents versus the disruptors fighting over our savings accounts.
That's the whole game right there. The implication of all of this is what they're calling the institutional reckoning. Capital is fleeing the gray market. It's leaving unregulated systems like Tether, which the report says is facing binary outcomes.
Binary outcomes, meaning it either gets regulated or it goes to zero.
Pretty much. And all that capital is flowing into compliant infrastructure, like USDC and these new bank-issued coins. The days of the Wild West in crypto are effectively over. The suits have arrived.
Okay, so moving from the digital world to the very physical, very messy world of geopolitics. The phrase used in the intro was, trade and territory are no longer separate.
This is the defining theme of 2026. We're used to thinking of trade wars as being about tariffs on steel or cars. Now trade wars are about buying land.
We have to talk about the Greenland crisis. January 17th, 2026. When I first read this, I honestly thought it was satire.
It does sound like it's from a comedy sketch.
Yeah.
Trump announced tariffs of 10% to 25% on 8 NATO allies, but there was a condition to lift them.
And the condition was?
The U.S. acquires Greenland.
You're telling me the market panicked because of a tweet about buying Greenland? That sounds like a massive overreaction. Surely the trading algorithms know that's not a real policy. You can't just buy a country in 2026.
It's not about the transaction actually happening. It's about what the request signals to the rest of the world. It signals that the U.S. now views its alliances as purely transactional. It views NATO partners not as allies, but as landlords that it can bully.
And the markets hated that signal.
They despised it. Gold surged to $5,600 an ounce. Just think about that price for a second. That is pure panic buying. The U.S. dollar index had its worst week since 2025. The market realized this wasn't just bluster, it was the weaponization of trade policy to literally redraw the map.
And the reality is Denmark isn't selling, obviously.
Right, sovereignty is off the table, but the instability remains. The threat of those tariffs is still hanging there, and it has seriously damaged trust in the U.S. dollar as a global safe haven. If the U.S. can hold NATO economies hostage for territory, where do you park your money?
They park it in gold.
You park it in gold. And this ties right into the broader theme of U.S. economic nationalism. The magazine mentioned the OBBBA.
The One Big Beautiful Bill. You have to love these names. It sounds like a reality TV show finale.
It's a fusion of nationalism and economic policy. I mean, the era of free market neutrality is dead. The U.S. government is now taking equity stakes in critical companies. For example, they're holding a golden share in U.S. Steel.
So the government owns a piece of the steel industry. Like, the White House has a veto on the board.
Effectively, yes. They're saying this industry is too important to fail or to be sold to a foreign owner. It gives them veto power over mergers, acquisitions, or even shutting down plants. It's steep capitalism, American style, very similar to how China manages its own strategic industries.
And while the politicians were arguing about Greenland, the lights went out. Or, I guess, the gas stopped flowing, the energy freeze off.
This was a genuine shock to the system.
Yeah.
Winter Storm Fern. It hit the U.S. production basins really hard. We lost 17 billion cubic feet per day of natural gas production in one weekend.
That number sounds huge, but give me some context. What does 17 BCFD represent?
That's roughly 15 to 20% of total U.S. production. Just gone, vanished overnight. It's enough gas to power millions and millions of homes. The pipes literally froze solid.
And here's the kicker. Europe relies on U.S. LNG liquefied natural gas for more than half of its supply.
Correct. So when the U.S. sneezes, Europe actually freezes. The U.S. export terminals couldn't get the gas, so the ships couldn't leave port.
So who wins in that scenario? If the U.S. can't supply the gas, who does?
Qatar and Saudi Arabia. Qatar is in the middle of a massive expansion of its production, up to 142 million tons per annum. Saudi Arabia just secured 20 MTPA in new offtake deals. The big takeaway here is that energy security now trumps price.
Right.
Europe doesn't care if Qatari gas is more expensive. They just need to know that it will actually show up. The U.S. looked unreliable during Storm Fern, and reliability is the new currency in energy markets.
This global rupture theme is just popping up everywhere. Davos 2026 happened in January, too. Did anything actually come out of that, or was it just champagne and snow boots as usual?
It was a failure. The magazine calls the spirit of dialogue there pure theater. The markets have totally decoupled from the rhetoric you hear at Davos. You had the global elites talking about cooperation while their home governments were seizing territory and putting up tariffs.
The cognitive dissonance must have been deafening.
Completely. And then we had some real military action, too. Venezuela.
Operation Absolute Resolve. That sounds like a movie script.
It really does. The U.S. military captured Maduro in Caracas. It pushed oil prices up because of the geopolitical premium, but it also signals a potential regime change in a country that sits on the largest oil reserves in the world. If Venezuela comes back online as a Western-aligned oil producer, that changes the global energy map for the next 20 years.
And the Middle East. Still tense.
Very tense. There's a regional war warning between Iran and the U.S. Trump's rhetoric is locked and loaded. It's another major reason why oil was up 13% in January.
And finally on the news front, the Epstein files. The DOJ released 3.5 million pages.
The market impact here was mostly noise, but it matters for specific reputations. There were 200 mentions of Trump, though. To be clear, no wrongdoing was alleged. There were mentions of the Duke and Elon Musk. For traders, this is really about key man risk.
Right.
If a major CEO gets dragged into this, their stock is going to drop. But systemically, the market kind of just shrugged it off. It seems the market has developed a very high tolerance for scandal.
Okay, let's play connect the dots. We have all these events. Let's explain the big market moves. Bitcoin was down 10.58%. Why? If regulation is a good thing, why is the price going down?
So 3 main reasons. 1, ETF outflows. We saw $6 billion leave the spot ETFs. That's just straight up selling pressure, people taking profits from the last rally.
Simple supply and demand.
Exactly. 2, Fed policy. Rates are being held high, around 3.5 to 3.75%, and that hurts risk assets like crypto. High rates act like gravity on speculative assets.
And 3.
Macro uncertainty. When the world looks like it might be on fire, people sell the most liquid, riskiest thing they own first. And for many, Bitcoin is the easiest thing to sell on a Friday night when scary news breaks.
Contrast that with gold, which was up 10.56%, almost a perfect inverse.
A perfect inverse correlation. And why was it up? 1, geopolitics, the Venezuelan alliance scares. 2, currency debasement fears. People are terrified of what the U.S. government is doing with all this spending and tariff talk. And 3, central bank buying. Foreign nations are buying gold to diversify away from the dollar because they saw what happened to Russia's frozen assets.
And WTI crude oil up 13%.
That's the Middle East tension premium. It's about 45% of the move. And then you have OPEC plus keeping discipline on supply. Plus the U.S. frees off constricted supply in the short term. Less supply plus war fear equals higher prices. It's simple math.
Here's the one that surprised me. The Russell 2000, the small cap stocks, was up almost 6%. Why are the small companies winning when the big tech giants are stalling out?
This is what they're calling the small cap rotation. Investors are looking at the U.S. economy and seeing some resilience, but they are tired of paying for those expensive tech stocks. So they're moving money into smaller, more domestic U.S. companies. It's a bet on the U.S. domestic economy surviving the global chaos.
And small caps are also seen as a beneficiary of this economic nationalism, right?
Exactly. If the U.S. puts up tariffs, the domestic producers, who are often smaller companies, suddenly face less foreign competition. Tariffs hurt the big multinationals, but they might actually help the local factory.
That's a great insight. Okay, let's shift gears. We've talked macro, now let's go micro, the community corner. This issue features a really deep dive interview with Abdelaziz, the founder of AnyTrader.
This was a fascinating read. Abdelaziz isn't your typical Wall Street guy. He was a civil engineer who became a quant trader.
I love that background. Engineers think so differently. They don't rely on gut feeling. They rely on load-bearing calculations.
They do. He started trading way back in 2010 in what he calls the Wild West of Forex, dealing desks like IronFX. He saw the ugly side of the industry very early on. And his whole philosophy really evolved from that chaos. He moved from guessing to calculating.
He had a great quote in there. Coding is not an optional skill. It is the fundamental tool of the modern trader.
That is a hard pill for a lot of people to swallow, but he is absolutely right. If you can't code your strategy, you can't backtest it. If you can't backtest it, you are just guessing. He talks about the retail trap, how most traders treat the market like a casino. They're chasing a lifestyle. The Lamborghinis in Dubai.
The Instagram trader, buying courses from guys standing in front of rented jets.
That's the one. Abdelaziz says real trading is boring. It's disciplined. It is completely data-driven. It's about survival, not hitting jackpots. It's about grinding out a small edge day after day after day.
And the community has built some incredible tools to support this kind of boring trading. Let's spotlight the Boart scanner.
Yeah, this was created by a user named Revvin01. It's a Python-based tool, and it looks for what he calls confluence. It analyzes the market across 23 distinct disciplines: smart money concepts, Wyckoff theory, Elliott wave, things like that.
So it's not just relying on one indicator.
Not at all. It will only signal a potential trade if more than 70% of those different analyzers agree. It's like having a committee of 23 experts in a room, and you only make a move if at least 16 of them raise their hands.
That must filter out so much noise.
It does. And then there's the Enabac tester by AZML87. This is described as a cloud-native gym for traders.
I like that analogy. A gym for traders.
It allows you to practice on 5 to 10 years of historical market data without risking a single cent of your real capital. It's built on React 19 and Cloudflare R2. The idea is simple. You wouldn't step into a boxing ring without sparring first. So why would you trade your life savings without properly backtesting your strategy?
And they also mentioned risk management, which is maybe the most important part.
The ATR risk management proof. It really emphasizes math over dreams. It uses the average true range of a market to calculate your position size. So if the market is very volatile, you automatically trade smaller. If it's calm, you can trade a bit larger. It automates the discipline that most humans just don't have.
This community seems incredibly focused on applying the scientific method to trading.
That's their entire brand. Data-driven, scientifically backed. They are allergic to hype.
So what does all this mean for you, the listener, right now? What are the investment implications for February 2026?
Okay, first the Fed. The Fed pause is real. We are looking at a holding pattern through at least the first half of 2026. Rates are going to be steady at 3.5% to 3.75%, so don't expect a rate cut to come and save you. The Fed is watching the inflation data like a hawk.
So in that environment, where do we put our money?
The advice in the magazine is to position for range-bound environments. Markets aren't going straight up or straight down. They're chopping around. In that environment, long volatility can be attractive, so buying calls on the VIX, you profit from the chaos.
And the rotation we mentioned earlier, is that still the play?
Yes, continue to move away from the expensive mega-cap tech. Look at small caps, the Russell 2000, and emerging markets. The risk-for-reward ratio looks better there. And for crypto, we're in an accumulate zone.
Meaning it's a good time to be buying dips.
Exactly. Bitcoin has very strong technical support between $87,000 and $92,000. If it dips down into that zone, the smart money is likely buying.
And we have some key dates to circle on the calendar for February.
We do. February 11th is the employment report, the NFP. February 12th and 27th are what the report calls the inflation trilogy, CPI and PPI. And February 18th, we get the FOMC minutes.
So expect volatility around those dates.
Oh, yeah. Don't be surprised if the market whipsaws hard on those days.
Before we wrap up, there was one tech trend mentioned that I found hilarious but also kind of scary: the binge watch bias.
Yes, this is a real phenomenon. They found that midnight streamers, people binge watching Netflix or YouTube late at night, are actually moving the S&P 500 futures market.
How is that even possible? Are they trading while watching reruns of The Office?
Pretty much.
Yeah.
Liquidity is so thin in the after-hours market that bored retail traders watching shows on their couch are placing trades on their phones, and it's causing measurable blips in the market.
That's incredible.
It really shows how interconnected, maybe how fragile the liquidity really is. 1,000 people watching a cliffhanger and impulsively buying a stock can actually move the needle when all the big institutions are asleep.
That is wild. Your late-night binge is actually moving the market. It's the butterfly effect, but with streaming services.
It creates what they call phantom liquidity. It looks like real volume, but it's just boredom.
Right.
And algorithms can get tricked by it.
So the final thought for this deep dive, what's the big takeaway?
I think it's that the world has fundamentally shifted. We've moved from an era of U.S. dominance to a multipolar rupture. The easy money, the strategy of just buying the S&P 500 and holding on, is probably gone. The edge now is in data and in infrastructure, whether that's the infrastructure of crypto regulation or the infrastructure of energy reliability. If you aren't looking at the plumbing, you are going to get flushed.
That is a very powerful image to end on. Now, for everyone listening who wants to see the charts, the data, and the full text of the laws we discussed, you need to get the magazine.
Absolutely. You can download our magazine for free, this issue and all the past issues, at as1mag.com.
And it's not just for English speakers, right? It's pretty inclusive.
That's right. The magazine is available in 3 languages: English, French, and Arabic.
It's a monthly release, and remember, a monthly deep dive like this one discussing the magazine is published on our YouTube channel.
And if you're passionate about finance and you want the quick hits, follow our TikTok channel at eNiTraderHub.
Finally, if you seek a pro-grade community of traders to exchange ideas with and to learn trading in a scientific approach based on data and not on dreams and imagination, you should visit our website.
Yeah, head over to nitrader.com to learn more about us and how you can join our community.
Thanks for listening to this deep dive. Keep your head on a swivel, and we'll see you next month.
Stay safe out there. It's a crazy market.